Well, I think this is the question that many investors globally are asking themselves. I mean, it is a confidence game. And oftentimes, this kind of news flow, bit of a boost in confidence for the domestic consumer, that can have some short-term sort of boosts here. And I mean, bear in mind, Chinese equities are very oversold. So scope for a technical bounce certainly wouldn't rule it out. But in order for, I think, international investors to gain more confidence in China, first and foremost, some more joined-up policy with regard to the direction of monetary policy, tackling the disinflation issue that's there, and also some sign that the real estate issues are behind us, I think are going to be key there. But there's been an awful lot of volatility in policy making in China over the past few years, and I think that's something which is giving international investors pause for thought.
There could be that superficial bounce, though, in that property part, right? Because even if they were to offer stimulus and to ensure that the signs are done with regards to how badly it's fallen off for the property sector, that could still be a superficial bounce if they haven't sorted out those structural reforms underneath, because that seems like a long-term problem for them.
Well, I think you've got a situation in China, if you actually pare it back, this is now an economy where the population is in decline. And when we look at our long-term capital market assumptions program, where we plot out 10 years worth of views across the world for economies and markets, the biggest driver for economic growth is still labour force. And if labour force is declining, then it's very difficult to have a strong long-term view on the economy. So while China certainly does have a capacity to add investment to its economy, to think about trade, etc., the underlying issue is it's a shrinking economy, so you're asking the other drivers of economic growth to do an awful lot of heavy lifting there.
There's a lot of relabeling around Chinese assets. As some are saying it's un-investable. That's something we've heard a lot in recent years. Others are saying it's now an alternative investment. It's not correlated to any of the traditional assets. Do you think that's the case? That if you think of China and you think about getting involved because of the low levels on the valuation, you treat it like an alternative investment?
Well, I don't think you can treat the world's second largest economy as either an alternative investment or uninvestable. That would be wide of the mark. I think there's a couple of things you've got to look at. First and foremost, Chinese government bonds, the fixed income market is vast. It's not particularly hugely held by international money. And bear in mind, you have a disinflation problem out there, scope that rates could come down. Could be something that's interesting to look at under those circumstances. The equity market, those days of the middle 2010s when we saw the big tech firms really soaring to Silicon Valley-like valuations, they're probably behind us. But the reality is there's still huge stock-picking opportunities in China. There's a lot that the economy needs to do to evolve in terms of the financial sector, dealing with an ageing population, transportation, services, etc. So this is one where it's probably a case of being more laser focused on the individual stocks rather than necessarily trying to trade it as a play on its beta to global growth.